So the Asia region has been performing over the last decade. Private wealth has increased dramatically, with Apex high net worth now overseeing more assets than anywhere else in the world. Between the year 2000 and 2020, the world's net worth tripled. In Asia, wealth grew fourfold, with the region now accounting for 42% of total global wealth. As we witness growth of the middle class alongside a rapidly aging population, we are seeing the disruption of traditional distribution channels by the entrance of new ones. Opportunity to sell across borders are emerging as appetite and interest in portfolio diversification increases, along with the quest and the continuous search for yield. Over the last 3 decades, we have seen the success of fund regimes such as UCITS and AIFMD, which created a degree of regulatory homogenization inside the EU, making it easier for firms to sell their products cross-border and globally. As Asia's domestic and regional wealth has grown, there's been a desire by regulators here to replicate such regimes. The ASEAN CIS, launched back in 2014, that was an initiative to establish a single market and production base for funds between Singapore, Malaysia, and Thailand. The framework allows, upon regulatory approval, the units of a fund authorized in one CIS domicile to be offered in the other participating countries. In February 2019, we saw the launch of the Asian Region Funds Passport, the conclusion of many years of negotiation. The passport enables cross-border offerings of managed funds to retail investors. This supports the development of an Asia-wide investment management sector through improved market access and regulatory harmonization, with Australia, New Zealand, Japan, Thailand, and South Korea signing the initial memorandum of cooperation, and Singapore then signing a statement of intent. Now, whilst these initiatives have seen some slow adoption due to currency challenges, tax complexities, or even just a low appetite, they do indicate a very keen interest from regulators to develop a structure that will benefit the industry regionally, and they provide the opportunity to develop a much better understanding of what is needed to drive a successful scheme. Individually, regulators are looking at expanding the number of available fund structures in region. Hong Kong launched its Open Fund Structure, OFC, in 2018, giving managers the opportunity to establish a local fund in the form of a company to exist then alongside the known unit trust. More recently, in January 2020, here in Singapore, MAS launched the Singapore VCC, which can be used by open-ended and closed-ended traditional and alternative asset management strategies, including hedge funds, private equity, and real estate. The adoption of VCC is growing at a pace, and the number of Singapore VCCs has increased by 65% from last year to October 2022.